expense to accumulated depreciation. Remember, this is the opposite account. So the rule would be different. If increase is credit, it decrease, it debit. Right? So depreciation expense increase, debit, and increase in accumulated depreciation, because this is the opposite of the assets. Opposite of the asset increase mean credit. So that's why this entry makes sense here. Right? So nothing happened to the equipment. It's still the 24,000. What we are doing, we are increasing the accumulated depreciation, 400, 400. Everybody, you get the idea what's going on here?
I understood why you put, how you allocated the numbers, but I still quite don't understand the meaning of accumulated depreciation equipment.
Just don't worry about right now. Just try to understand that we created a new account, which is the opposite of the asset account. We call that accumulated depreciation account. Okay? Don't waste it here. So the nature of the accumulated depreciation account is that it shows the sum of all depreciation expenses. Its balance increases over assets lifetime. It is contra asset account, which means it has a normal balance of credit balance. Normal balance of assets are normally debit balance. So since it is contra account, its normal balance is going to be credit balance. So a contra account has two distinguishing characteristics. It always has companion. So companion, we have the long-lived asset account or equipment account over there. So its normal balance must be opposite of the companion account, right? So don't worry about right now here. If you don't understand here, we have a separate chapter on that. We will also learn this concept from scratch over there as well. So how we are going to record this depreciation? So look at here. We call this book value. Cost minus depreciation is called the book value. So we purchased this equipment 24,000, right? And 400 is the depreciation. So how much is the value? Is the book value left? 23,600. So this is called the book value. This is called the cost value, and this is the depreciation. Understand? So let me just clarify one more time. The utility or the benefit of having accumulated depreciation is that we know the cost value of or the purchase value of equipment is 24,000. If we eliminate all these values, so it becomes 23,600. So 23,600 won't give us the amount that how much we paid for the equipment, right? So that's why we created the accounting. In accounting, we create the accumulated depreciation, which is the opposite of equipment, in which all the depreciation goes and it increases one by one. For example, in June it is 400. In July it will be June depreciation and July depreciation. Which means 400 plus 400, it becomes 800, and with less 800 it becomes 23,200. So it will be increased from time to time until it reaches the equipment value. Okay, let's move forward. So what will be book value of the Friday's equipment at the end of July? At the end of July, what's happening? We have the balance sheet here. We have another 400 per month. So book value would be 23,200. So this value would be decreased to this value, and this value would be here 800, right? So this is the answer that I put here. So this is the original balance sheet of the Starbucks Corporation. You see, they have different assets, and you see the accumulated depreciation here. So these values, the buildings, the store equipment, roasting equipment, furniture and fixtures, these values shows the cost price. So now the manager know that for this particular branch or for this Starbucks Corporation, the building was $225 million. The roasting equipment was $323 million. And how much we have used? We have used total of $4,244 million, right? And you see 2011 and 2012, these are the two balance sheets, its value start increasing, right? So that's why, so the beauty of having accumulated depreciation is that it shows us the cost value plus the accumulated depreciation account increase with time to time. And one thing, did you notice here that it has also increased? And we said that the cost value would gonna be, it remains the same. The only reason here is that if you see 225 minus 219, answer is $6 million worth of additional building they purchase. Now you can easily find out that how much new building they have invested in or they have purchased. They have purchased $6 million worth of new building, right? So the beauty of having accumulated depreciation in our balance sheet account is that it includes all the depreciation. Which kind of depreciation? Accumulated, which means from time to time, and time passes by, the depreciation is going to be increased. Okay, now accrued expenses. Accrued expenses, they are the expenses that are recorded before the cash payments, which means expenses occurred but you did not pay, like salaries, tax, interest, rent. If you paid in advance rent, we call this prepaid rent, that becomes our asset. But if you did not pay, we create liability, right? If you did not pay, that becomes your liability. So sale tax, you sell the goods throughout the year or throughout the month, and at the end you need to submit the tax to the government. So on 30th of June, how much is the tax that you need to submit? Until you submit, before that it becomes our liability. When you paid, it becomes your expense. Fair enough? A worker worked for you for 30 days or a manager worked for you for 30 days, and after that you pay the salary. 30 days, you are not paying the manager according to days, daily wages. No, you are paying after 30 days, right? So on 15th of the month, the salary is payable for 15 days. At the 30th day, the salary is payable for 30 days. So that's why we create liability. So let's do some example here. Here we go. So in companies, we have rules when the payments are going to be made. Here we go. Let's talk about this illustration here. Suppose Freddy's Auto Service Incorporation pays its employee a monthly salary of $1,800. Half on the 15th and half on the last day of the month. The monthly salary is 1800. Half he will be paying on 15th and on the 30th or the last day of the month. This is the calendar for June. So the office is not going to be open on Saturday and on Sunday. But theory or the rule says you must pay your employees on Saturday and you close on Friday. So when you are on closing your factory or your office on Friday, are you paying your dues on Saturday? No, you would be paying on Monday. So it means salary, you create a liability that salary is payable, and then on Monday you pay the salary. Here we go. So what are the entries? So during the June, Friday's paid its employees the first half of the month's salary. So what will be the June 15 entry? Entry going to be salary expense to cash, right? When you pay the salary, if you are open on Saturday, pay the salary cash, but on 30th, you are not open. In that case, you create a liability. So half of the 1800 is 900. The due date is 30, but you are not open over there. So you create a liability. Salary expense occurred, yes. The workers had worked for all these days. And then you create a liability. So in this case, your expense is now complete, 1800. Right? But 9,000 you already paid, 900 you already paid in cash from our previous slide here. See? But the other 900 you still need to pay. So that's why we create salaries payable. Understand? Similarly, the accrued revenue. Revenue recorded before cash received. So when you perform the service, customer will pay you later. We create a liability. When it's time to receipt means we create assets. So revenue recorded, accrued revenue recorded before cash received. So when cash is not received, we create customers, account receivable. So revenue that had been earned but not yet collected, we call that accrued revenue. So this is just a normal revenue. That is, you perform services on account. Entry would be account receivable to sales or revenue. There we go. Assume that FedEx hires Freddy's on June 15. FedEx will pay Freddy's 1600 monthly with the first payment on 15th of July